was a packed week.
Yeah.
What did you see this week that maybe we didn't pay enough attention to?
Well, I think U.S. debt is front and center for investors. Everyone knows that we have a debt ceiling coming and probably a showdown, hopefully not as bad or not worse than 2011 when equities fell about 20% in the weeks following. But I think the thing that some investors might be missing or underestimating, the Congressional Budget Office's report also talked about the debt outlook now that we're in a slightly higher interest rate environment and we continue to load on debt with some of the provisions we made, reasonably so, probably, during COVID. We needed to do something. We could argue how much. But when you look at the CBO's report, if we extend existing tax and spending provisions, we're going to have debt to GDP in 10 years of 130%. So you mentioned Japan earlier in the segment. Yep, we're looking at that kind of stuff. The other one that struck me is that the interest payments on our debt are going to increasingly have a crowding out effect. And if you look just at the next 5 years, the CBO's estimates, it would suggest that our interest rate payments on our debt will be greater than defense spending altogether. That's scary, and it's going to mean that government, which is already very polarized, will have to make some very difficult fiscal trade-offs. And it's already challenging,
Boy,
and it's going to get worse.
That's not good news necessarily.
No.
How about you, Mona? Is there anything you actually noticed this week you think we're not at least paying enough attention to?
Yeah, and by the way, that debt ceiling one is a great one. It'll probably start flaring up again come July or August of this year. But yeah, another one that we've been paying attention to closely, David, is the earnings outlook. And, you know, keep in mind, we're in the middle of Q4 earnings right now. They're trending towards a negative 5% growth rate. But in fact, when you look at Q1 and Q2 earnings forecasts now, they have come down quite a bit. So we're looking at negative 5% and negative 3% respectively. So that brings us to 3 back-to-back quarters of negative earnings growth in the S&P 500. So of course, you know, while we may not be seeing that technical negative GDP growth, we are looking at a potential earnings slump ahead of us. And so it'll be interesting to see, and probably not as likely for markets to be able to power right through that, but perhaps something that investors have not yet seen or been thinking about, hasn't yet come quite to the forefront in the headlines either. The other interesting part of the earnings story, of course, is 2023 broadly. Earnings expectations have come down. They were about 10% plus coming into the year, and they're now closer to 2%, but perhaps a little bit more downside to go in those downward earning revisions as well. So until that kind of bottoming process in earnings happens, it will be difficult to stage a more sustainable recovery. So I do think that's something to keep in mind, especially looking at Q4, which is still looking a little elevated in our view. But, you know, I think the earnings picture in the next couple of quarters, it will be a little bit of a tough one.
And I think if I could pick up, Mona, on something you said, a sustainable move. I think that is going to be the key for this year. Last year, we had some pretty long-lasting trends. I think this year is going to be like a ping pong or a pickleball match, where it's just going back and forth. You'll get some data that suggests this immaculate disinflation, and then the next month we'll have something hotter than expected. And the changes in expectations for liquidity, the changes in expectations in earnings is going to keep us back and forth. And I think for investors, we don't want to take our eye off the ball of the longer-term trend. And I agree with you. I think the risk is that we could get an earnings recession even within the volatility along the way.